Hello everyone, my name is Mohit Mehra and thanks for tuning into this Zero the Educate episode. So this is the third Zero the Educate episode that we are doing with Prateek. And Prateek, thanks so much for doing this. We've had some amazing conversations with him about the basics of index funds and how international investing works. Everyone, please do check them out. Now, the reason we are talking to Prateek today is because he and his team at Motilal Oswal have launched a new 5-year constant maturity G-Sec ETF, which is the first one in India, right, Prateek, if I'm not wrong?
That's right. It's the first one.
It's an interesting product for a lot of reasons, and also ETFs, although they've been around for a while, are not really popular in India, and investors have had some misconceptions around the product. Today in detail, we'll talk about the basics of ETFs and we'll talk about the Motilal Oswal 5-year G-Sec ETF as well. Pratik, before we talk about the G-Sec ETF, could you briefly talk about how your journey in the markets has been for somebody who might not have tuned into the previous podcast?
No, sure. Thanks, Mohit. Good evening, everyone. I think good evening, depending on when you see this video. But nice to meet all of you, and thank you, Zerodha, for having me again. It's always been a pleasure to have and talk to you guys. I think you guys are very good at going out there and building a marketplace and also educating investors. I'm excited for this session. So my previous 2 sessions were about what index funds were. So what are some of the basics of index funds and how investors can really adopt them to build portfolios. And my second session was on international investing. So this is the third one, which is on debt investing, something even I am sort of new to, but I've learned a lot over the last few months. Essentially, if you look at my background, so I have a background in finance and technology, so spent my first half of my 20s in more traditional finance, investment banking, private equity, hedge funds, and then spent my second half of my 20s in technology. So before this, I was heading operations at a fintech company in Silicon Valley where we were building solutions for investment advisors, and we ended up doing really well. We went to an accelerator called Y Combinator, and took also raised VC venture capital money and expanded a team and all of that. So that was fun. And now I'm come to India and focusing on building the passive business, something which I saw it is extremely popular in the US, and hopefully we can popularize it in India as well over the next 3 to 5 years time. So that's essentially my background in short.
Yeah, Pratik, before jumping into the debt ETFs and what you're launching, could we briefly talk about the fundamentals of what an ETF is and how does it work?
Yeah, sure. Essentially, when ETF stands for exchange traded fund, and it's literally what that is. It's literally a mutual fund that can be traded on the exchange. So essentially, ETFs can be of any sort of fund. So you have passively managed ETFs, and now you also have actively managed ETFs in the US. But essentially, historically, ETFs have always known for passively managed funds. And essentially, what ETFs are, it allows you to trade index funds on an intraday basis and also use them as long-term investment opportunities. Essentially, if you're looking at investing into index funds, so they are only something which you can buy once a day. Whereas ETFs, because they trade on the exchange and because they track the real-time prices of the underlying stocks, you can actually go out there and buy it like a share on the exchange. Those are essentially what ETFs are. ETFs are as popular as index funds globally. And essentially the reason why ETFs are slightly more popular today is because they give you the added flexibility of buying it at different times of the day. So that's typically what an ETF is. What is an ETF is a structure. What is the underlying of the ETF? The underlying of the ETF is a bunch of stocks, and those stocks are, I think, historically called index funds. So index funds are funds that track a particular index. So I'm sure a lot of the folks out here in the video they know about Sensex and Nifty. Those are very, I would say, very simple, I think terminologies. They are representations of how the broader markets, I would say, move. So if today someone says Sensex goes up, that means the average stock price has gone up in that particular day. So essentially, when you're buying an index fund, you're buying the broader market. So essentially, if the broader markets go up by 10%, your portfolio will also go up by 10%, which is why index funds are extremely simple and easy instruments to buy. So essentially, ETFs are these sort of instruments, but are tradable on the exchange.
Pratik, you mentioned that an ETF is like a mutual fund which is traded on the exchange. Uh, could you briefly elaborate on the differences between a mutual fund and an ETF as well?
Yeah. So essentially, so what are the differences between index funds and ETFs? In index funds, you have a single NAV that is calculated at the end of the day. So if you say invest during the day in that particular index fund, you will get that end of day NAV as your purchase price. Whereas an ETF, you can actually purchase at various points in the day. So the price that you pay on the exchange is the price that you get for buying that basket of securities on an ETF. In terms of the index fund, it's slightly more easier to set up SIPs. So you can automate your investments with index funds. Whereas in ETFs, I think it's relatively much more difficult. So you'll have to actually go out there and invest in lump sums or invest in a continuous basis for you to make sure that you are investing monthly or quarterly or whatever it is. Essentially, I think even the costs are very different. When you look at index funds, there's something called a total expense ratio. And that is essentially what you're paying yearly to the asset manager to manage your money. Say you pay 0.1, 0.2, 0.3, whatever it is, that is the fees that you pay. And this is all inclusive. Whereas in an ETF, there are additional fees that you're paying to buy the same instrument. You are obviously paying the TER, which is total expense ratio, but you're also paying brokerage, you're paying STT, which is securities transaction tax, and you're also paying a small amount in liquidity cost because the price that you pay on the exchange may not be the most perfect price of the underlying product. So if you add these three, I think in the current scenario, ETFs are maybe slightly more expensive than index funds, but over time we'll see that the discrepancies will come down over time. So these are, I would say, some of the differences between these two products.
So, given the disadvantages that you listed in terms of the cost, why would still somebody want to invest in an ETF as opposed to a index fund directly?
Yeah, so essentially, I think if someone is looking to maybe trade an ETF, or he or she wants to buy it at one particular price, or then obviously you can go out there and buy the ETF. Essentially, what's happened as the markets get mature, even the prices of ETFs have become a lot more efficient. So what will happen? So for example, in the US, ETFs are so popular out there that buying an index fund may not be as enticing as buying ETF because prices are so efficient that you can actually buy the ETF at that perfect price. So essentially India obviously will get there over time, maybe the next 3 to 5 years time. But so far, I think, one of the biggest complaints that we get from investors is that ETFs are very inefficient, which I don't disagree with. I think the reason why ETFs are not very popular is because, they haven't been marketed to retail investors. They'll be marketed to institutional investors, pension funds who don't really go on the exchange. Whereas for the ETF market to develop, we need investors to go out there and buy and sell on the exchange. Which currently is happening in small amounts, but hopefully that will lead to more efficiencies in the future.
Pratik, you spoke about the liquidity and how efficient ETFs are for retail investors. Could you briefly list the do's and don'ts before buying an ETF, like a summary of something that somebody might want to consider before they go out and purchase an ETF?
Yeah, no, great question. When buying an ETF, I would say a big thing that investors should watch out for is the price on the exchange. So what price you're paying, say what is the quoted price that is listed on the exchange versus what is the price of the underlying basket of stocks. So there is something called NAV, which is obviously the quoted price, and there is something called the INAV, which is the indicative NAV. So essentially, when investors are going out there and purchasing these ETFs on the exchange, they should ideally look at the underlying price, which is called the INAV. This number they can either get through a data provider, or they can go to the AMC website and also see the value of the INAV. And essentially, investors should make sure that their purchase price is extremely, I would say, close to this INAV. So I think that is a big thing that I would recommend investors buy ETFs, because I'll be honest, I've seen a lot of investors who end up paying crazy amounts above what they should be paying, or they're selling their investments for say like 1%, 2%, even 5% cheaper than what they could have got. So I think, investors should not just blindly go out there and buy and sell. They should understand that ETFs are not as efficient, and they should essentially, look for the price that they should be selling or buying at, and then make sure they buy it around that time, around that price.
And at any given point, if somebody is buying or selling an ETF, even if they like know the price, they should make sure to use a limit order, let's say, to make sure that if they use a market order, it doesn't execute at a random price because the quantity was not available.
Yeah. Yeah, exactly. I mean, I think you guys are experts in limit orders. So I think, yeah, exactly. So make sure that, your price that you're quoting doesn't expire and you have a limit order in place so that, it gets, if it goes below the amount, then the price gets canceled. So essentially, yeah. So make sure that your range is pretty much very close to the indicator now.
And apart from this, brief summary of do's and don'ts, is there any analysis that somebody might want to do when investing in an ETF? Anything that they should look into, read, understand?
Yeah, I think, in terms of analysis, I think ETFs are pretty much, I would say, simpler, very simple funds. Essentially, I think, today India ETF market is still very nascent. But essentially, I think, there are a lot of options for investors to go out there and buy ETFs. I think, so if you look at the breadth of ETFs in this country, you have, say, a large cap, you have a mid cap, well, you have a multi-cap ETF, you have several sector ETFs, you have now debt ETFs also coming in, and you also have international ETFs also, which we have the NASDAQ. So essentially, I think, when you're looking at ETFs, investors can also look at it from a trading perspective, but investors can also look at them from an investment perspective. So instead of say going out there and buying a mutual fund, which is also equally good, I think it's a lot easier. Investors can also see ETFs as places where they can park their money for 3, 5, 10 years. Essentially, I think in the US today, just to give an example, most investors build long-term portfolios using only ETFs. So people have this misconception that ETFs are only for trading and buying and selling, buying today and selling tomorrow. Essentially, ETFs can also be great vehicles where you can park your long-term money, where you can just grow with the ETF itself. So I think that is something which investors should do. I think investors should also use ETFs only if it matches their risk profile. So essentially, to give an example, sector funds are extremely volatile, and they're also the most popular ETFs. And essentially, the reason why they're popular ETFs is because suppose you you have a call that tomorrow IT will do well. So instead of you trying to choose between Infosys and TCS, you can just simply buy the IT ETF, and I think make sure that you can get that gain. So essentially, I think even though ETFs are very enticing and easy to access with, investors should ideally look at their risk profile and stay away from, I think, highly volatile. For example, sector ETFs are slightly on the volatile side, so don't usually use them for long-term investing. So essentially, I think that is something which I would recommend investors do.
One final follow-up question on this, basics bit on ETFs. Unlike mutual funds, they also have this redemption and creation mechanism and market makers. Could you briefly elaborate on what that means then?
Yeah, sure. So, what happens in a mutual fund is that your money is managed at a pool level. So whichever inflows comes out and whichever outflows comes out, the net amount gets invested in the underlying securities. So that's essentially what an ETF or what a mutual fund is. But whereas in an ETF, what happens is if you had to buy a basket is the lowest amount that would needed to buy the entire sort of basket of 50 to 100 securities. So for example, if you had to buy one basket of say a NASDAQ 100, which is all 100 securities in the same proportion as the NASDAQ 100 index in the US, that would cost you around 2 crore rupees. So that's pretty expensive, so what the AMC does is as someone who does want to say invest 2 crore rupees, then they can come directly to us. They don't have to go to the exchange. They don't have to deal with the market maker. They can come directly to us and create that basket at the best possible price. So that's basket creation and redemption. Even if someone say a Nifty 50 ETF has a basket size of say, 15 lakhs. Now, if someone wants to redeem that much, they have the option of coming directly to the AMC and then redeeming the entire basket with us, where they will get a very good price prices at that point. So this is how baskets are created and redeemed. Essentially, most of the redemption and creation process happens by an authorized participant or a market maker. So a market maker is someone who ensures that there's enough liquidity on the exchange. So for example, today there is zero demand for say one particular Nifty ETF at some AMC, zero demand, there's only supply, and you wanted to sell some, and you want to sell some, say aggressively, or you really want to get rid of your ETF units. What happens is the market maker goes out there and buys the units at the market price. And if he has enough units, say, then he would redeem those units with the AMC. And at the same time, if you wanted to buy units on the exchange and if there is no supply, then the market maker comes in and sells you those units, which he can buy from the AMC at a much larger scale. So essentially, market makers are entities who make sure that there is enough demand supply on the exchange so that as an investor, you can actually buy units if you want to. You don't have to, so they ensure that there's enough liquidity, enough number of units trading on the exchange so that, you can buy and sell. So I think that is a very important part of ETF liquidity. Currently in India, market making is there, but it may not be as per global standards. And also because of, I would say, not much of demand and supply of these ETFs, prices may not quote the underlying best price, which is also why, I push investors to, keep checking their, or at least check the INAV or the indicating NAV before buying and selling. Because if, say, there is no demand and supply on the exchange, and there is no need for the market maker to correct prices. So the prices will just keep on deviating from what it's supposed to be, which is why I think it's very important for investors to, keep their, check their INAVs and trade.
Pratik, before we move to talking about the Motilal 5-year G-Sec ETF, can we cover the basic principles of investing in debt? Because in the last 3 years, we found that some poor decisions or uneducated choices that people might have made have come back to haunt them. And with that context in place, what is your view of debt in a portfolio, the role of debt in a portfolio?
Yeah. So Mohit, I think, debt is a very important part of your portfolio. It is essential. I think every investor should have some debt component in his or her portfolio because of the diversification impact that it can have, especially during bad times. So when equity is not performing, which happens every, say, 3 to 5 years or 3 to 7 years, you need that debt to give you that protection in case. And what happens is when you have this debt protection, you are not as vulnerable to sell your portfolio at a loss or to make really behavioral mistakes, which is one of the most important reasons to why investors lose out on equity investing. So I think debt is an extremely important part. I think, I think the debt, the way I look at it, is a means of capital preservation. So essentially the problem happens is when people try to really go out there and try and buy the best performing debt fund or the riskiest debt fund because they have this notion that debt is safe, and the fact that the highest yield will get the highest demand. And the other problem is incentives in the industry. Today what is happening is, or maybe not today, but maybe a year or two ago, the incentives were such that the fund manager that posts the biggest I would say returns in debt, which is basically taking more risk, will get the maximum inflows of capital. So if you look at the debt investing framework in India, the funds which had the highest risk also had some of the highest inflows of money. So because obviously investors want to, I think make sure that they optimize on the capital as much as possible. But essentially the way I see it, debt should be a means of capital preservation and nothing else. Yes, you can buy a high risk fund if you want, but make sure that you are a very small allocation of your overall portfolio to the high risk fund. Essentially, most of your fund should be in, I would say, AAA or maybe government securities, because the idea is to get maybe outperform inflation. Outperform a simple bank account is something which I would really, I would say, push investors to that. So I think your enemy is not the highest performing debt fund. The enemy is that, can you outperform inflation? Can you outperform a bank interest rate? That is something which I would recommend to investors as opposed to going after the riskiest fund where, it's not about what return of, because in that case, it's not about return on capital, it's about return of capital. So I think that is when you're jeopardizing return of capital, that means you're taking a lot of risk. So hopefully, I think, people have understood this over the last 1 year, and people have now, I think, looking at safety in a much more deeper lens. And even though something is AAA rated, I would say investors that, make sure that, you are fairly, I think, diversified between government securities and corporate bonds, because even I think ILFS was a AAA security, was backed by the government of India and still defaulted. So essentially, I think, you should look at something which is extremely safe, and then maybe also have a combination of corporate bonds, which you think is managed by a good fund manager.
Pratik, apart from this risk assessment mistake that people might make, have you seen investors make any other errors in judgment while allocating money to debt?
I would say, in my viewpoint, I think not really. I think I think the biggest problem is not investing in debt. The biggest problem is not investing in debt. So much of this country's capital is stuck in savings bank and fixed deposit. Today I think if you have an FD or if you have a savings bank account, you are underperforming inflation by 3 to 4%. So you're getting poorer every year by 3 to 4%. And this has been happening for the last 10, 15 years. And obviously now inflation's come down. Inflation used to be even higher, say in the early 2000s, maybe 4, 5 years ago. So I think the biggest enemy for the investor today is not a benchmark. It's not 40, 50% return. The biggest enemy is inflation. And essentially, even though people have, say, some of the capital in, say, debt markets and equity markets, essentially most people have a lot of their money stuck in, say, fixed deposits or, say, savings bank account, which I think is extremely inefficient. And today, I think with the development of the government securities market, you can actually get access to something which is as safe as a fixed deposit, which obviously slightly better returns. So I do think that the biggest mistake, at least I see, is that where people are investing maybe not as enough as what they can in their portfolio. People are very conservative. So I do think that India needs to grow from being extremely conservative to something where they can have a asset allocation of, say, 60-40 or 80-20, whatever it is, depending on the risk profile, which I think is a lot better because that's the only way you can really maintain your purchasing power of parity. If you look at, say, what we used to pay for ice cream or butter, say 30 years ago versus today, there's a huge difference. And the only way you can sort of maintain your spending power is by investing in, say, equity and debt. Obviously, you have to make sure that you invest as per your risk profile. But essentially, that's what I think. It is my opinion. But don't go overboard. Just because of debt investing, don't invest in the riskiest of stuff. Don't. I know people who lend to real estate debt at 15, 20, 25%. And just because I think of greed or whatever it is, and I think most people don't end up recovering that money. A lot of people end up giving money to their friends or in an unofficial way. And I have seen people make mistakes where just for the lure of 15-20%, they've lost all their capital. So I think choose something a lot more regulated, like the Indian mutual fund industry or the corporate bond industry, where that there is a regulator to make sure that money is given back to investors.
Pratik, what are some things, few things that you figured out while investing in debt in your own personal portfolio? I mean, you invest in debt, right?
No, I don't invest much in debt. So I am not a typical investor. I don't invest much in debt. Most of my money is in equity. I'm probably 95% equity. I would say been doing that for 10 to 15 years now, and obviously. The reason why I can do that is because is because I have a high threshold for, I think, volatility. I have my family's been investing in equity markets for 30 years now, and I've seen I've seen portfolios go down by 60-70% every few years, and we're perfectly fine with that. So essentially, I think, but this is not something which I would recommend most people to do. I think you should invest as per your risk profile and have at least a 20 to 40% exposure towards debt. Because essentially, I think what at least I have learned that having 100% equity versus 80% equity makes no difference to returns. Returns are pretty much the same. So in fact, what I've learned is I'm just taking excessive risk for no reason. So I think, investors should have a good allocation towards debt. I think the best strategy would be a multi-asset allocation where you have some equity, some debt, maybe some international, some gold. I think, and keep rebalancing until you have your target asset looking. That's, I think, the best, most prudent way of investing. And that's where actually I'm also heading.
And Motilal Oswal is known for investing in equity and not for investing in debt.
Yes.
So segueing into the presentation that you've got for us, what's the motivation here, and what's the philosophy that your team is bringing into investing in debt? Let's say in this case.
Yeah, so we have a pretty large private wealth business as well, which is, I would say, fairly skewed toward the debt segment, because when you're advising, say, ultra HNI clients, you have to have a multi-asset sort of solution. So even though obviously as a manufacturing house, we are equity experts, as I would say to the public, we want to be wealth managers. But essentially, I think the fact that we're equity investors makes sense to why we're launching a passively managed product, because you don't really need a lot of brains to manage a passively managed product. You just have to get these feeds from NSE or whichever index provider is, making sure that your investments are pretty much close to that. So essentially, I think debt investing is more about giving investors building block for asset allocation. And we do believe that, I think debt is, at least in India, is equally important as equity. I think what we've seen even in our experience is people tend to first start off with liquid funds or, like a instant redemption fund, and then they tend to go towards equity investing once they're comfortable with that. So I think debt is a great segue for someone to start exploring the mutual fund industry, and then obviously they can explore the equity side as well. But essentially, we don't see ourselves as experts in debt, which is why we're coming out with a passively managed product. So there's not a lot of expertise needed in this sort of product. It's a very simple, it's a single security product. And I think what we've learned is that when it comes to investing, you keep it simple. And this is actually a very simple fund.
Pratik, would you like to elaborate more on the product now? Could
Yes.
you share the slides with us?
Yeah, sure. I can share a few slides on the product. Let me just see. Can you see my presentation? Let me see if I can full screen it. Just 1 second, sorry. Yeah, so essentially, the product that we're launching is a government securities ETF. So it's an ETF, so it's something which can be traded on the exchange. We talked about the benefits of ETFs today. So you're essentially buying a debt fund that you can buy like a share on the exchange. So just like buying a share of, say, Infosys or TCS, you can actually buy this single security on the exchange. Essentially, the 5-year G-Sec is a very interesting product because it's the second most liquid segment. So just to take a step back, so what are government securities? Government securities are issued by the government of India. These are backed by the central government, and they're essentially issued to pay off some of their, for governments to manage their balance sheets, right? And this is a very big segment. And the guys who are essentially very involved in this segment are institutions and banks. So the entry, so if you as an retail investor wanted to go and buy these securities, you had to say put in 10, 20, 30, 40 lakh, maybe 1 crore and above. And essentially a lot of the trading of these securities happens on the phone. So there's no secondary market for government securities. It mostly happens on the phone. So essentially what we are doing is we're actually getting this entire market, essentially the second most liquid, which is the 5-year, and making it available for a retail investor. So essentially we will be doing the buying and selling on the phone, but the trading activity which will happen will be a way of retail investors getting access to this product. So government securities, the reason why they're very popular today is because, if you see today, if you put your money in a liquid fund, or if you put your money in say a bank account, post-tax, you'll probably make, maybe 3.5%, which again, as I said, is underperforming inflation by quite a bit. So I think people want safety, but they also want an area where they can enhance their yields or enhance their returns, which is where this product really comes in, because essentially it has the same safety characteristic of a fixed deposit. In fact, it's probably safer than that. The chance of a default is close to zero, and you're getting slightly higher premium than what you would make in that particular product. And thirdly, this also has a lot of tax advantages over buying, say, a fixed deposit or something else where you're paying 35% tax, whereas out here, if you invested for, say, 3 years and more, you can actually get something called indexation benefits, where you can adjust your purchase price by inflation. So essentially in this sort of a product, your pre-tax and post-tax returns are pretty much very similar, which I will show on the slide. So essentially, I think it's a very simple product. It's a single security product. So what you will be holding is one single security, which is the 5-year G-Sec. The 5-year, because if you look at the G-Sec market, the most popular, the most liquid is the 10-year G-Sec. And by 10-year, I mean a 10-year duration. So what happens in debt investing is that when you buy a 10-year fund or a 10-year security, that security will expire in 10 years, right? So you buy something at 60, say 90, and that will become 100 in 10 years time. So that's a 10-year security. In this case, we're buying a 5-year security. So the reason why 5-year is very attractive is because if you look at a 10-year, it tends to be very risky in terms of interest rates. So if you look at debt investing, so debt investing you get your regular coupon payments every year, but with debt instruments, they also are very, I would say, susceptible to price changes on the underlying interest rate. So for example, if interest rates go down today, your debt funds will actually go up, and vice versa. When interest rates goes up tomorrow, your debt funds will actually underperform. So that's how debt investing work. And a lot of fund managers, their job is to actually go out there and predict where interest rates will be in say 1 or 2 years for them to figure out which debt securities to buy at what duration, all of that. So when I say 5-year, this is a security that expires in exactly 5 years, but we don't hold the security till for 5 years. What we would do in this fund is something called a constant maturity. What does that mean? That means that whenever the 5-year becomes a 4-year, say after a year's time, we essentially roll it over to the next 5-year. So we would sell the 4-year and we would buy the 5-year again. It's ensuring that a customer is always holding the 5-year security at all times. So what this does is that it enhances your returns, because as a security gets closer to maturity, its returns also goes down. So 1-year G-Sec would give you only say 4% or 4.5%, whereas a 5-year will give you 5.5%. So essentially what we're doing is, by not rolling it down, by just making a constant maturity, or making sure that the returns are pretty much the same with the 5-year. So that's in short what the G-Sec market is. Let me talk about some of the advantages of this sort of a fund. So number one, it's no risk. So it's backed by the government of India. So it's practically nil. So people don't have to worry about capital. As I said, you don't have to. For debt investing, it's all about return of capital, not return on capital. So in this fund, you will make sure that you get your capital back. The second is very liquid. So the 5-year happens to be the second most liquid security after the 10-year. So the G-Sec market is a little bit. It is in India. It's not been developed. It's a secondary market because they're not retail investors, which is why liquidity is very low, which is why the 5-year is great, because liquidity is relatively higher side. So investors don't have to worry about us trying to make sure that the prices are stable. So it's very liquid and you can buy in the stock market. So that's two. Second is passively managed. If you look at debt funds in India, especially in the government security space, it tends to be say 2 times the expense ratio that we have. So obviously passive funds are cheaper. So you can expect to buy this security at a much low cost way. Fourth is simplicity, and this I talked about earlier. So essentially it's only one security. So for an investor, actually retail investor, you can buy something that you can buy for 10 lakh or 20 lakh rupees at 10 rupees just by this fund. And lastly, I talked about the 5-year, which is a balanced tenure. The 5-year is a very interesting, I would say, point in time, because you have some premium in terms of returns over say a low end or a low duration fund, but you also don't have that much interest rate risk that comes with a 10-year. So essentially it's you're basically in the middle. And essentially also what we've seen, in at least in my experience with debt investing, is that most customers tend to have a debt portfolio which is extremely long and extremely short. So the average duration tends to be around 5 years. So essentially buying something which, at least I have seen, most investors tend to have an average duration of around 4 to 6 years, which is exactly where this fund is placed. So I think these are some of the benefits of this fund. I'll just show maybe 3 or 4 quick slides before we move on. So why should you buy fixed income securities? We spoke about this earlier on. And as I said, diversification is extremely important. When an equity investor needs to buy fixed income, because it sort of hedges your downside. And also it gives you capital preservation, which I think is the most important thing when it comes to debt investing. then obviously I think the reason why debt investing in mutual funds is very, very preferable is because of the tax treatment. You can get indexation benefits if you invest for 3 years and above, which I think is makes a big difference. And I'll show you a slide that shows that. Essentially, these are some of the risks. So as I said, debt investing is not risk-free. There are risks associated with debt funds as well, and most people see debt as very risk-free. But people need to understand that there are risks involved in debt as well. So one is most important is credit risk. So this is what can really lead to you losing your capital, which is what's happened to a lot of investors today. So there's liquidity risk. If you can't buy and sell the product, then you're stuck with it. So if you're buying real estate, you're stuck with it. A lot of liquidity risk. Inflation risk. So if there's high inflation, you will underperform inflation if you've locked in your returns. That is there. And always interest rate risk. So interest rate goes up, your security goes down. So if you look at this fund, it has no credit risk. It has close to no liquidity risk. Inflation risk is also obviously depends on inflation, but essentially historically this fund has outperformed inflation year over year. And interest rate risk is medium because it's a 5-year. This is again a slide that talks about the fixed deposits are coming down. So historically, I think fixed deposit used to be pretty good instruments, but today I think investors should not be looking at fixed deposit because it's really low to a point where post-tax you don't really make a lot of money. And also more importantly, and this is a slide I've been talking about, the pre-tax and post-tax of a fixed deposit it's a big difference. Maybe whereas if you look at, say, the pre-tax and post-tax of a mutual fund that's investing in fixed income securities, it's a lot less difference. So in fact, the difference is pretty much the same. So in fact, this is the big benefit of really using mutual funds for your debt investments versus putting your money in a savings or a bank account, where you really get taxed very heavily and post-tax. So people normally sell you FD like get 7%, get 8%, get 5%. No one really sells you FD on post-tax make this much because taxes are relatively high. So so even if you are looking at a fixed deposit which has higher returns than what you could make on the 5-year G-Sec, post-tax it may not be true. So that's pretty much. Let me just go. This is a very important slide. And I think people in India don't teach I think equity investing obviously is not there, but debt investing teaching is even less. So this is a very good representation of interest rate risk that you can expect in your debt funds. So today I think most people obviously, at least starting investors, tend to put their money in liquid funds, which is fine because there is close to zero interest rate risk. But I do think that going forward, investors should look at funds outside liquid funds because liquid funds are not really, they're not meant for savings. They weren't designed for savings, but they by default become savings. Essentially, if you look at debt investing, you're looking at short duration bonds, medium duration bonds, and long duration bonds. And when buying these bonds, investors should know that they're not buying a steady, like an FD type of a product. They are buying a product which obviously will make money of coupons, but is also susceptible to interest rate movements. So for example, in a falling rate scenario, if interest rates goes down from say 5% to 4%, then your long duration bonds will go up by 8%. So this is the sensitivity of interest rates. Your 5-year will go up by 4% and your short will go up by 2%. So, and vice versa. If interest rates go up by say 1%, this is what you can expect in your portfolio when you're buying a bond fund, which is not a liquid fund. So I think this is a very important slide, and investors need to understand that there is interest rate exposure. So when you're buying a long dated bond, just because it's 7%, doesn't mean that you have to buy it, right? You have to see that, okay, are my goals 10 years long? Does it make sense for me to buy it? Essentially, I think most retail investors should stay away from here. They should just focus on short and medium term because that is much easier to handle for investors in terms of their debt investments. So this is it's a very interesting slide. So I think, so most investors would say that why should I invest in government security? How much the government will pay you? Why should I invest in government securities? This slide shows that a simple fund like a 5-year benchmark has beaten most actively managed debt funds in India in the last 15 years. So, and this is staggering. Even I didn't know about it, and these funds have corporate bonds in them. They have these AAA corporate bonds that pay much higher interest rate than a government security. So what it means is that obviously, I'm not saying this. I mean, this is not going to continue, or who knows if it continues or not. But what this shows is that I think predicting interest rates in the future is a lot more difficult than what people think. So if you buy, say, and again, there is a fund manager bias when it comes to debt investing as well. So when you're buying a debt fund, obviously you're buying it at a YTM or a yield of say 6%, but you getting there may not happen because the fund manager might take some call on interest rates and say 1 year from now where you might, your interest rate might go down. So I think, it's very important to understand that predicting yield curves is as difficult as predicting the weather markets will be in 1 year. We all have learned in the last 1 year that market timing is very difficult. You have to be really lucky to get timing right. It's the same with debt investing. Getting timing right, interest rates is very difficult. Today, a lot of investors are expecting yields to go up, tomorrow, but no one really knows what's going to happen. No one expected us to come here. I mean, no one expected a debt fund to give you 9% returns. Going forward, but still, I think the point here, you're getting something which is quite efficient, without I think breaking the bank. So this is again a 3 year. This is a little bit complicated, but essentially what you're getting, I think we would recommend investors to hold this for a minimum of 3 years, for them to really get the tax advantages. And the worst possible scenario in the last 20 years has been 2.5%, 2.6 to 3%, which is really you timing to perfection, which doesn't really happen. As best is around, so middle is about 8%. So essentially what we're saying is that, it's very, for capital preservation is there, but even if interest rates move against you, even then capital is preserved. So last slide, how is it compared to, to something like a fixed maturity plan? So this is essentially something like a Bharat bond, which again is a great product. I think I really recommend it. But essentially that is a expiring product. So when you invest in, say, a Bharat bond or any fund that expires, the good thing is that you can lock in your returns, but once a product expires, you have to pay tax and you have to basically roll your position to the next 3 year or next 10 years. Whereas this fund will not expire. This will stay 5 years for life. So that's basically the big difference between these two funds. Essentially, that's the main difference. I think other subtle differences are because it's only one security, there is not much tracking error. There is no reinvestment cost that you can expect on this. And I think it's a lot more simpler and easier to understand. But obviously, yes, there is interest rate risk, very small compared to, say, a fixed maturity plan, where if you hold it in maturity, you know exactly how much you'll make. So that's pretty much, I think, our product. So our NFO is going on. It will close on Wednesday, which is the 2nd or 3rd of December.
Second, I think, yeah.
Sorry?
2nd of December, I think.
Yes, 2nd of December. The minimum is 500 rupees, and I think you can buy it on the exchange when it opens in a few days after that. So again, this is some return statistics. This presentation is available on our website. Feel free to, I would say, use our presentation.
Pratik, I also saw that you guys had filed for a fund-of-fund like application. So will this ETF be a part of that fund-of-fund in terms of application?
That's right. Yeah, so that's one of the reasons why we're launching it, because we wanted to build a purely 100% passive fund of funds, which will be the first in India, and this fund will be the debt component of that fund of funds. So that fund of funds will be a combination of maybe 2, 3, or 4 asset classes. We'll have domestic equities, we'll have US equities, we'll have a debt fund, which is this one, and you may or may not have gold. So essentially it's a multi-asset fund of funds, and this will be a part of that.
Like you've touched this briefly earlier as well, and you've talked about the risks in debt. Here, what would be the predominant risk in investing in, let's say, G-Sec? And since you know that you're investing for at least 3 to 4 years, 5 years, because there are tax ramifications, and this is a 5-year constant maturity G-Sec that the fund is managing, what would be the biggest risk that an investor might want to think about?
Yeah, I think
the worst case scenario. What is the worst case scenario here?
Yeah, so I showed the worst case scenario. If you're holding it for 3 years,
2%.
Yeah, 2.5, 2.6, 2.7%. is what you could make. This happened, I think, in 2007, 2008 during the financial crisis. But essentially, I think, it's a relatively stable fund. I would say that if you invest today and suddenly the interest rates move up by 2%, then obviously you can see some lower performance in the first maybe 1 or 2 years of your history, which is why we're saying this from a 3-year perspective, at least, because next 1 or 2 years, obviously most people have a view, but no one really has a view as to where the interest rates would be 3 or 4 years from now. So essentially, I think having a 3-year vision on this fund makes sense. And I think, yes, the immediate risk can be if interest rates go up dramatically. And currently, I think, obviously, I don't speculate on interest rates because I don't know if I am good at it, but at least the government has mentioned that because of the heavy borrowing program, they want to keep interest rates as low as possible. It makes it easier for them or cheaper for them to borrow from the marketplace. So I think next 12 to 18 months, at least 12 to 14 months, at least the government has maintained that they will keep interest rates the way they are. Post that, obviously, a lot depends on the recovery. If the economy does not recover, then obviously you can expect the same or even lower interest rates. So I think essentially, I think it's the biggest risk I would say is that there's a sudden upward move of interest rates. Then you could see, I would say below, I would say 4% returns. That can be a possibility. Yeah.
Pratik, one last bit on like ETFs in India. Let's say in the next 5 years, what do you think would be the products, the ETF products that you would want to see in the market, and which are the ones that you are working on at Motilal Oswal?
Yeah, so I think so. We are working on a bunch of stuff. I would say, I think next 5 years, I do think that I think the international category is something which is still underpenetrated. So we are coming up with 2 or 3 more funds next year. 2 will be happening next year, early next year, hopefully, and both will be non-US. So currently we are well, not technically, but we are the market leaders when it comes to international investing in the US. We have 2 good funds, and we will be coming up with 2 other funds that are non-US. So I think those will also give investors further, I would say, options to diversify in a relatively low cost way through passive funds. Apart from that, we're also trying to do like a all-weather innovation or like a more technology or a disruptive technology sort of a fund, which is still under, I would say, under back and forth. So hopefully we can come with that sometime next year, because I do feel that there is appetite, and I do feel that technology is going to play a much bigger role in the future than it has in the past. So that is one area where I think there could be a possibility of a product coming out. And apart from that, I think thematic ETFs are going to be big in India. Although I'm not very positive, I'm not very passionate about thematic ETFs because I think personally I feel that thematics are not good for investors. There's more money lost than gain in thematics because they tend to be popular exactly when everyone's talking about it. So you tend to come at the top and then you tend to lose money. So essentially thematics is great if you require some level of market timing. So essentially that's which why I mean it's great obviously if you're trying to substitute stock investing with thematics, perfectly fine. But essentially I think most investors should stick to something which is diversified across sectors, because that happens to be the best for long-term wealth creation. ESG is a big, I would say, theme. I am a very vocal critic of ESG. I think I mean, just to, yeah, I mean, I don't understand it, to be honest. I don't know, and it's so subjective, because, I mean, it doesn't, yeah, I mean, Google's been sued by the Justice Department, by EU, and it's still an ESG company. And you have, Amazon, just because they've outsourced their deliveries, that becomes an ESG company. Whereas Walmart does everything in-house, so they have control on all the deliveries, and they're not an ESG company. I mean, it is very arbitrary. It's very subjective. And one index provider has Facebook as ESG, one index provider does not have Facebook as an ESG. So I think. I mean, Tesla should not have, I mean, it's a great company. I own shares in Tesla, but it should not be ESG because it has a history of very low governance, with the founder tweeting random stuff. So essentially, I think, even though it's a theme that's picked up, I don't understand it. And that's why, I mean, I stay away from it, but I'm anyway a critic. But essentially, if it takes off, it's good for the world. But currently it's just, it used to be good, but I think now because of Wall Street coming in, they've really misused it in a very big way. So hopefully things will come back to how they were supposed to with ESG. But essentially, I think, we're looking at more international funds. I think a big, I would say, style of investing that might happen, not now, but maybe in a couple of years, is called factor investing, where essentially people can use a quality or a momentum or a low ball sort of strategy to manage their investments. This is, again, it's called smart beta. And that is a big theme that will play a big role in India. It's not a theme that will outperform the index, but it requires some level of market timing. So it's not as smart as what most people think, but essentially it's a great way of trying to play on one particular sort of factor if you want to take a call on that for the next 3 to 5 years time. So I think these are some of the themes that we are working on currently.
Just to conclude, a couple of questions, like on a personal note. One would be how you invest, and you spoke about that your portfolio has been 95% mostly in equity the last 10 years. Have you seen that evolve, change in any manner, or do you want to change it going forward?
Yeah, so I think so. I have 95. So I have some. So I have some. I've been doing SIPs in crypto for a while, and finally it's showing some. I'd say after 3 years. So I think I have some alternative assets like cryptocurrency. I have, but it's a very small amount if you compare it to my overall account. But essentially, I think what I would do differently is probably diversify across geographies. So right now, all my money is in a single mutual fund, which I think is fine. It's perfectly fine to have a single mutual fund in a portfolio. I think if you look at traditional finance theory, you don't really need more than 30 stocks in a portfolio if it's diversified across. So I have one single fund, but essentially I've also started, say, doing an SIP in international. So I think that's what I would do. But essentially, I'm a high-risk investor. So essentially, maybe a bit of domestic, bit of international is something which I will probably move towards in the next 1 or 2 years.
Pratik, any mistakes or lessons that you want to share with the people who are watching this?
Yeah, I think so mistakes would be, my stock picking career was very short-lived. I think what I've learned is that, stock picking is perfectly fine. If you want to do it, you should do it, but do it with a small part of your overall portfolio. And if you do well, then you can increase that. So what mistakes that I have made in the start is this was like maybe 15 years ago when I had an all stock portfolio and I used to trade them and invest and all of that. And I really ended up losing some bit of it. So essentially, and that's what essentially I've seen with majority of investors out there who are buying direct stocks and trading. But essentially, I would say that, it's perfectly fine for you to trade. You just do it with a smaller amount. So if you're, say, looking to invest or looking to, grow your 100 rupees, put maybe 90% in long-term investing. And then maybe you can experiment with the 10% in stock trading. And if you're successful, then obviously you can enhance that. That's a big mistake that I have made. And I do tell investors that, if you want to trade, you should, but do it with a smaller corpus. And if you're successful, you can increase that over time.
One question that people would probably ask and want to know about would be what books or movies or let's say podcasts would you recommend if somebody wants to learn more about investing? Even if it's non-investing related but helps them along their investing journey, anything as such that you would want to recommend to people?
Yeah, I mean, so I am an avid reader. I tend to read maybe a book or two a week. So I have a lot of book recommendations, but essentially, I would say just Google top 15 investment books. I think the older the book, the more gold it would be. Something that was apparent 50 years ago, it's still people are having the same problems when it comes to investing. So, Warren Buffett letters to shareholders, Benjamin Graham, Phil Fisher, Burton Malkiel, all these people are being stalwarts. Their books have survived the test of time. And I think those are really good reads for anyone who's looking to get into investing. I would say just stick to the classics. They're really good quality. And what I would say is that, I think people tend to overcomplicate investing, or at least in mutual funds and stocks. And these books really help you simplify and break down what you really need to do. If you're a stock picker, then you should look at Phil Fisher, you can look at Benjamin Graham. And if you're a mutual fund investor, then you can look at, say, someone like a Jack Bogle or a John Bogle, who has great books in mutual fund. So essentially, this is what at least I would recommend. In terms of podcasts, I don't know if there's any good modern podcasts on investing, but I would say that good investors are not really people who are good at finance. Good investors and people who are good at psychology. So I think read up a lot on psychology, understand your biases. Investors' biggest enemy is their biases. And Charlie Munger, who's Warren Buffett's partner, said that if I know where I was going to die, I wouldn't go there. So biases are basically places where you're going to die. And if you know them, if you understand them, there are a list of 25, 30 biases, then you will not go there and you will become a smarter investor. So I think in addition to reading those books about investing, which I think is extremely important, also read up on books on psychology, because investors who are great do both really well. So something like a Dan Ariely or like a Thinking Fast, Thinking Slow, or whatever books you think even influence Cialdini, whatever is good in psychology, which will make you understand how humans operate and think, that can be a very good value add to your investing skills.
And recently, people who have been psychologists have been winning economic Nobel Prizes, and so that just justifies what you're saying.
Yeah, exactly. I think economists as a profession has been thoroughly, I would say, people don't see a lot of credibility in you calling yourself an economist. Whereas psychologist is more credible because you're all. It's basically you are running like a lab rat sort of an environment. You have people come in and do these tests, and you understand how humans behave and act. And essentially, also economics. The fundamental principle of economics is that the assumption is that people are rational. If you look at any economic theory, the underlying assumption of people are rational. Whereas psychology is all about how people are not rational,
right.
which is a lot true. If people were rational, no one would really make mistakes. What you see today in the stock market, right? So I think you have to believe in irrationality, which is why I think psychologists are a lot practical. I think listening to them is a lot more practical than maybe listening to economists who can basically say whatever they want and get away with it.
Thanks, Pratik. Thanks for doing this. I'm sure everyone who's listening in and watching this, they had some great takeaways. I did for sure. We expect that we'll do more of these with you. Thanks.
Yeah, thanks Mohit for having me, and I look forward to. And this is a great chat. I really loved it. I think I really prefer one-on-ones than having a PowerPoint presentation. But thank you so much, and thank you everyone for listening. And look forward to more things. And for listeners, you can get in touch with me directly on social. I'm pretty active on LinkedIn, Twitter, whatever it is, and I'll be more than happy to answer your queries out there. So thank you so much, and take care.
This conversation is for informational purposes only and should not be considered as investment advice. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Please consult your financial advisors before making investments.